What's up guys, and welcome back to WSM Research. Before we get into the video, keep in mind that we are not financial advisors, and any investment you make has the potential to lose money. This video is for informational purposes only. Make sure to do your own research and consult with a professional before making any investment decision. On this channel, we talk about some of the most relevant developments in the stock markets today and try to provide information on topics and particular stocks that we think are the most important. Aside from following some of the most interesting tech companies on the stock market, like Palantir and the upcoming IPO of the dominant e-commerce platform in South Korea, Coupang, we also closely track developments in the markets and economy in general and try to figure out what their implications might be on everyday investors. Today we're going to talk about a recent market development that has many investors worried, but will end up undoubtedly making a lot of money for others. If you haven't noticed, we are in the midst of a tech-heavy sell-off in the markets right now, and everything from Tesla to Palantir are down massively from their February highs. In fact, Tesla closed below $600 a share for the first time since 2020, and the NASDAQ is now in a correction. By correction, we refer to a drop in stock prices of at least 10%. Due to several different reasons, this sell-off has hit tech stocks the hardest. The NASDAQ 100 index is usually considered one of the main technology indexes because it has so many big tech names in it, including Amazon, Apple, and Google. It's a market cap weighted index, so the big names like Apple and Amazon are the biggest determinants of price action. It does not include any financial names like the big banks that heavily influence other indices like the Dow Jones Industrial Average. As a result of being so heavily exposed to tech stocks, the NASDAQ 100 has been an outperformer of the broader market since 2008, and in fact has been a very strong performer since its inception in 1985. But along with outsized returns, the tech-heavy NASDAQ also has bigger drawdowns than other indices like the S&P. That's one reason why the recent sell-off hit the NASDAQ so hard. Some people panic when their stocks sell off, but if you have the stomach to take the volatility, some investors view the sell-offs as buying opportunities. Warren Buffett says the stock market is a device that transfers money from the impatient to the patient. What he means by that is that if you have a long-term view on a stock and are willing to stay long even through market volatility, he says that in the long run you'll be rewarded for that investment discipline. Today we're going to take a look at the recent tech sell-off and find which stocks have been hit the hardest. Since tech was the sector that dropped the most, we'll just look at stocks in the NASDAQ 100 index. We'll look at which 3 stocks have gone down the most since their highs of last month, how much each of them has gone down, and their valuations now that they have pulled back. The first stock on the list is Peloton, with a 33.3% decline since its February highs. Although Peloton is not a super high-tech company, it is included in the NASDAQ 100, and our main goal is just to find beaten down stocks. The stock has plunged in the past month because it is viewed as a stay-at-home stock that will go out of favor with the reopening on the horizon. However, growth in the most recent quarter continues to be strong, with 4.4 million subscribers total by the end of the quarter. That's more than double from a year ago. Total revenue also skyrocketed 128% to more than $1 billion, and they earned 18 cents of earnings per share. Their subscription, revenue, and total usage of their workout products have all been steadily increasing throughout the past year, so they are coming off a strong base of growth. The only question is, will this growth continue, or at least maintain current levels, after the economy is fully reopened? Bank of America analyst Justin Post says that the launching of new lower-priced products as soon as this month will be a catalyst for future growth. Also, many believe that the growth they experienced during the pandemic will be sticky because people who started using Pelotons will continue using in the future, and their subscription-based revenue models will continue to make money from those customers. The high valuation was one of Bank of America's main concerns for the stock, but after the market sell-off slashed a third of its value off the stock, it would be interesting to see what he says about the stock now. The next stock on the list is Tesla, with a 31.5% drop since its recent February highs. We all know Tesla, the incredible story of Elon Musk in revolutionizing the entire automotive industry with gigafactories, electric vehicles, insane acceleration, and unparalleled automation in the manufacturing processes. The Tesla story is truly incredible, and I think we can all agree that Tesla pretty much has the potential to dominate the automotive industry over the next decade if they can keep on its current trajectory for innovation. That being said, there have long been concerns that its valuation has become a little too insane, overtaking the entire rest of the automotive industry combined. But after briefly touching $900 a share in late January, it has now come down more than a third of its value since then to less than $600 a share. Cathie Wood's ARK Invest remains incredibly bullish on Tesla, going as far as to say that they think Tesla could reach $15,000 a share in the best case scenario by 2024. Even if you think that valuation is a little optimistic, if shares can recover to pre-sell-off levels, then that would already be a 50% gain. Number 3 on the list of most heavily beaten down stocks of the past month is Moderna. They make the innovative mRNA coronavirus vaccine that has been so instrumental in the fight against the pandemic. Their stock has had a pretty wild ride over the past year, initially popping and riding the pandemic up to almost $200 a share, which would have been close to a 10 times return from a year ago. But concerns about its profitability after the pandemic, as well as how exactly they'll be able to monetize a vaccine that is considered a product for national security, have periodically pulled the stock in. It now trades 29% below its February high, at about $132 a share. But it could be a stock that ends up doing well after the pandemic due to its innovative technology in the biotech sector and the recurring nature of vaccinations. They also recently announced that they had entered into a supply agreement with the Philippines government for 13 million doses of their vaccine. According to Oppenheimer, Moderna's ability to market vaccines into the future, along with valuation multiples given to other biotech companies like Regeneron and Vertex, a $100 billion valuation for the company seems reasonable. After the recent sell-off, Moderna has a market cap of about $53 billion. This is based on estimates of future sales of vaccines. According to their investor presentations, Moderna became cash flow positive in 2 quarters of 2020 and expects to only improve profitability, revenue, and its financial position in 2021 and beyond. If you believe that Moderna is a legit company that can make a difference in the biotech sector with its innovative technology, it might be worth considering picking up a few shares at the newly depressed prices. Alright guys, that wraps it up for this video. If you like this content, make sure to hit that like button for the YouTube algorithm. Also, subscribe for future videos. Leave a comment telling us how you plan to play the tech sell-off. In the meantime, thank you guys so much for watching, and we'll see you in the next video. WSM Research, signing out.